Right, let's talk about something that happens constantly, thousands of times a day, inside every big company. Now, I know the expenditure cycle sounds, well, kind of dry, right? But trust me, it's way more than just paperwork. Think of it like a financial shield, carefully built to protect a company's cash. So let's dive in and see exactly how this shield works.
You've probably felt this yourself, right? I mean, have you ever wondered why big companies seem to wrap everything in endless red tape? Just to buy a simple office chair, you need forms, signatures, approvals. It feels like so much hassle. But here's the thing, all that bureaucracy, it's not just there to slow things down. It's a really important defense against some pretty serious financial dangers.
And believe me, those dangers are very real. We're talking about things like shady kickbacks from vendors, paying for stuff that was never even delivered, or worse, sending money to vendors that don't even exist. We're talking about billions of dollars lost to corporate fraud every year. So yeah, that red tape we were just talking about, that's the shield. That's the defense that stands between a company's bank account and all of these threats.
So how do you even start to build a defense like that? Well, it all comes down to one core principle, a foundational idea that holds the entire system together. And it's called segregation of duties.
So what is that exactly? Simply put, segregation of duties, or SOD for short, just means that you never, ever let one single person control a financial transaction from start to finish. You know, you can't have the same person who asks to buy something also be the one who approves it and receives it and pays for it. No way. By splitting up those jobs, you create this incredible system of checks and balances.
And this little chart here shows you exactly how that works in the real world. You see, you've got one person, the initiator, who asks for something. Then a totally different person, the authorizer, who approves it. Then a third person, the custodian, who actually receives the goods. And finally, a fourth person, the recorder, who pays the bill. Four completely different jobs done by different people in different departments. No overlap.
And look at the difference this makes. It's night and day, really. On one side, you have a single person doing everything. That is just a massive, high-risk invitation for fraud. But on the other side, when you split those duties up among a team, suddenly you've got a low-risk setup with a super strong defense. Okay, so that's the big idea, the theory behind it all. Now let's see how it actually plays out step by step.
All right, so let's get into the nitty-gritty. We're going to start at the very beginning of the process, which is all about building the foundation of that shield. And you know, it doesn't start with someone just buying something. Nope. It starts with an officially recognized and approved need.
So here are the first 3 moves. Step 1. A department realizes they need something, and they fill out a formal request called a purchase requisition. Step 2. A manager looks it over, makes sure it's actually necessary, and checks if it's in the budget. Then, and only then, do we get to step 3. The procurement department steps in, picks a vendor from an approved list, and issues a formal purchase order.
And this purchase order, or PO, is so important. You have to understand it's not just a piece of paper, it's a legally binding contract. It spells out everything, what's being bought, how much of it, and at what exact price. This is the document that prevents a vendor from suddenly changing the rules of the game later on. It just locks everything down right from the start.
Okay, so the order's in. It's official. What's next? Well, now we have to verify reality. It's time to make sure that the thing we ordered on paper actually shows up, you know, for real, at the loading dock.
Right, so when the truck pulls up, it's the receiving department's time to shine. Their job is to inspect the goods, check the quality, count everything, and do it all independently. They create a document called a goods received note to prove what came in. And remember that whole segregation of duties thing? This is it in action. Because this team is totally separate from the folks who ordered it and the folks who will pay for it, they can give a completely unbiased, objective report. No funny business.
And now we're getting to it. This is the absolute heart of the entire process, the core of the shield. This is where all those separate pieces of paper we've been talking about finally come together. It's called the 3-way match.
And I am not exaggerating when I say this is the big one. Auditing pros will tell you flat out, 3-way matching is the single most critical control in the entire expenditure cycle. If a company can just get this one step right, they can stop a huge amount of fraud and a ton of simple mistakes. So what are we matching? It's these 3 documents locked together. First, the purchase order. That's what we agreed to buy. Second, the receiving report. That's what we actually received. And third, the vendor invoice. That's what the vendor is asking us to pay. You see the 3 pieces?
So the folks in accounts payable take these 3 documents, lay them side by side, and ask one simple but incredibly powerful question. Do they match? Do all 3 of them agree on the quantity, the price, and the terms? Perfectly?
And the answer to that question is everything. If they don't match, even by a little bit, the payment is stopped. Full stop. The invoice gets flagged and someone's got to figure out what went wrong. But if they do match perfectly, then and only then is the invoice approved. This simple check makes it almost impossible to pay a fake invoice or, accidentally pay the same bill twice.
Okay, so the 3-way match was a success, the invoice has been approved, now we can move on to the final stage of the whole process, actually paying the bill and getting it on the books correctly.
This part is pretty straightforward. After the successful match, a supervisor will usually give the final okay for the payment to go out. Then the whole transaction gets officially recorded in the accounting system. And to make sure everything stays tidy and accurate, accountants will regularly double-check that the payment details in the subledger line up perfectly with the big picture in the general ledger.
So, we've gone through all these steps, all this paperwork, all these different departments. What's the bottom line? What's the real-world impact of all this? Why does any of it really matter?
Well, the official auditing standard on fraud makes it crystal clear. When you have weak segregation of duties, when you don't do that 3-way match, the result is almost always the same. You get kickbacks, you get duplicate payments, you get payments to fake vendors. This entire process we just walked through, this is what stands in the way and stops all that from happening. It's what protects the company's money, pure and simple.
So the next time you run into what feels like corporate red tape, hopefully you'll see it a little differently. It's not just there to be annoying. It's a shield, a really smart, multi-layered system designed to guard a company's financial health. And while this whole process protects a company's money, it does leave one final, interesting question for you to think about. What processes are protecting yours?